Hi, my name's Darryl Wilson from Affluence Funds Management, and today I want to talk to you about our Affluence LIC fund. Firstly, a little bit about Affluence. On slide 2, you can see we have two investment funds available. The Affluence Investment Fund itself invests in a range of over 30 unlisted funds run by some of Australia's best fund managers. And back in 2016, we set up the Affluence LIC fund, which specifically targets listed investment companies on ASX, and that's the one I'm going to talk about to you today. All of our funds, including the LIC fund, have some features in common. Firstly, we like to try and align our interests as a fund manager with our investors as much as possible. That means that the first money that goes into every fund is our own. It means that we charge only a performance fee based on each fund's performance and no fixed fee like most managers. And finally, we target regular income, long-term capital growth, and hopefully a less volatile ride than the share market as we deliver the outcomes for our investors. Now, the Affluence LIC fund started, as I said, just on 4 years ago, back in 2016, and we believe it's the only one available in Australia that invests specifically in LICs. There were three things in particular that attracted us to listed investment companies when we started looking at them in detail back in 2015. The first of those is that the quality of managers in listed investment companies is very, very good. In fact, much higher, we think, than in managed funds in general. And that's because to achieve a listing and an IPO of an LIC, generally a manager has to be able to demonstrate a pretty good track record. So the choice of quality of managers is very, very high. Secondly, there's a wide variety of different investment choices available in LICs now. So as well as Australian equities and global equities, you can look at LICs that invest in alternative assets such as infrastructure and private equity. You can look at LICs that have alternative investment strategies such as long, short and market neutral. And you can get these from a wide variety of different types of structures. More recently, we've seen a number of listed investment trusts come onto the ASX and they invest specifically in debt instruments and fixed interest type loans. So that adds another opportunity for LIC investors. And finally, the thing that excited us most about LICs when we looked at the sector first was not only are they listed on ASX and they're traded regularly, like an ETF, for example, but unlike an ETF or a managed fund, the market price of a listed investment company is set by the market. And that means it can diverge quite a lot from the underlying net asset value or the NTA or the value of the investments that the LIC holds. Now, some people see that as a risk. We see it as an opportunity, as a potential way to add some extra profits over and above the returns of the LICs themselves. And I'll explain a little bit later why we think that is. In addition to those features we found attractive, there's also a couple of things right now that means that it's a good time to be looking at listed investment companies. The first, obviously, as you'd be aware, is that markets have come back quite a bit since the start of the year. So right now the ASX is about 25% below where it was at the end of January. And that provides, if nothing, a pretty attractive entry point into markets relative to where they were earlier this year. Secondly, and just as importantly, as you'll see on slide 5, the discounts to NTA that the LICs are trading at are quite a lot higher now than they've been over the last few years. So the data on slide 5 comes from our LIC fund portfolio, and you'll see for the first 3 years or so that the LIC fund was going, the discounts averaged between 6 and 8%. So the average LIC was trading 6 or 8% below the value of its assets, its investments that it held. Over the last 12 months, that's blown out quite a bit to the point where at the end of April this year, the average discount on our portfolio was 22%, which is around 15% greater than it's been on average over the preceding period. So again, that provides an opportunity to buy a dollar's worth of assets for 78 cents, if you like, or a 22% discount to the underlying value. Slide 6 outlines the basic things we look for when we look to construct a portfolio of LICs. There are 3 types of things we look for in an individual LIC. The first one is what we call alpha generators. That simply means the ability to be able to outperform markets over a full market cycle. And as I've said before, I think there's a pretty decent percentage of managers within the LIC world that can do that. Secondly, we're looking for specific discount outcomes. So in essence, what we're looking to do there is to buy an LIC cheaper than it should be. And if it gets more expensive than it should be, we can sell it. And we can do that consistently. If we can do that consistently through a whole cycle, we can hopefully add some extra value over and above what's returned from the LICs themselves. And then finally, there are sometimes event-specific situations where a particular LIC makes sense to hold for a short period of time. Examples there might include things such as wind-ups or changes in structure, and we're seeing some of those occur in the market at the moment, and we expect a few more. And that allows us to profit from specific events over a period of time. Now we look at all those opportunities, we combine them together into a portfolio, and when we do that, we look at a bit of a top-down view. We look at markets and where they're sitting. We look at opportunities that are available in different sectors and relative pricing, and we use that to decide the weightings within our portfolio. The result of that is generally a portfolio of between 25 or 20 and 35 LICs. At 30 April, as you'll see on slide 7, we had 31 LICs in the portfolio, and you can see there a breakup by various different variables of the portfolio. So by market cap, you'll see there's quite a wide range of small to medium LICs. We tend not usually to hold the very largest because they tend to follow the benchmark quite closely, and so when we're looking for pricing anomalies, we more often find them in that small to medium space. We've got at the moment about 8 or 9% cash in the portfolio, and then about 2/3 of the balance is allocated to Australian invested LICs. The rest is allocated to LICs that invest in global markets. And you'll also see a range of different investment strategies. Now that's important in terms of getting good diversification into the portfolio. So holding some long short managers, some market neutral, and some assets other than stocks is important to be able to manage some of those ups and downs in the markets. A little bit more about the way we approach our discount capture strategy. As I said earlier, it's really a way for us to try and add some extra returns over and above those generated by the LIC managers themselves. And essentially what we're trying to do there is identify when an LIC is trading cheaper than it should be and when it's more expensive than it should be. And there's a whole range of factors that we look at, but for example, one of the most important is where a particular LIC is trading in terms of a discount relative to how it has traded in its history. And to give you an example of how it might work, if we can buy an LIC at, for example, a 15% discount to NTA today, and at some time in the future we can sell that again at perhaps a 5% discount to its NTA, then we've managed to profit from that divergence. We've managed to add an extra 10% in value between a minus 15% discount and only a minus 5% discount. Now, depending on how long that takes, that can add quite a lot to investment returns, but even if, for example, it took 5 years for that discount to narrow, we can see that 10% over a 5-year period is about an extra 2% per annum that we've added to the returns from that LIC. And so if we can do that consistently across the board for a range of LICs through the cycle, we can add a reasonable amount of extra return over time. Now that's quite intensive. We use a specific model that we've developed to be able to do that, and what we're trying to do there is estimate as close as we can in real time what the net asset value is based on the public disclosures LIC managers make about their portfolios and based on movements in underlying markets. And we use that as a tool. It's quite intensive. It's not something necessarily that most investors would be able to accomplish by themselves. So we find we have a little bit of an information advantage in doing that. And that gives us perhaps access to a few opportunities that might not be obviously apparent to most people in the market. We've managed to perform quite well in down markets as well. And as I mentioned earlier, that's an important feature. So you will see on slide 9, there's a graph there showing the worst 10 months for the ASX 200 since our LIC fund commenced. The grey bars are what the ASX did in those worst 10 months, and the orange bars are what the Affluence LIC fund achieved that month. And you'll see that in all 10 of those months, the LIC fund performed better than the market, and in fact in 4 of those months we saw a small positive return, even though the market had fallen. And so the flip side of that, of course, is that when the market goes up very, very strongly, we may not keep up. But if we can deliver the same or better returns as the market over time, and we can achieve that with lower than average volatility. Most investors find that a useful trait to have in a managed fund. Looking to distributions, that's an important part of our focus as well, and it's also a focus for many investors in LICs. We aim to pay quarterly distributions, and we aim to deliver distributions which are as a minimum 5% per annum. And you can see on slide 10 the distribution history of the fund since we commenced, and we managed to do that quite well. In fact, since commencing, the average distribution rate has been around 6% per annum, plus some franking credits. On slide 11, you'll see the outcomes we've managed to achieve since the fund commenced around 4 years ago. The total returns at 7.7% have been around 2% per annum higher than the ASX 200. And that's despite the fact that those discounts have actually expanded quite a lot during that period. So that has acted as a bit of a headwind in the last couple of years in particular. We think that might be a bit of a tailwind going forward. So we're pretty pleased with that outcome that we've managed to achieve. Around 6%, as I mentioned, of that return has come from dividends. And in fact, we've done that with significantly less volatility than the market. We've also maintained through that period a very diversified exposure to a whole range of listed investment companies. So you're not just getting 1 or 2 or 5, you're getting generally 20 to 35 different LICs at any given time. So just to summarise what we think are the key points. Firstly, our interests are aligned with yours through the various factors we've got in the fund, like the fact that we co-invest and the fact that we charge only a performance fee, no fixed fee. There's clearly a diverse and we think a pretty high quality range of LICs in the portfolio. You are getting access to that discount capture strategy, which hopefully means we can add a little bit of extra value over time through buying and selling LICs at the right discount and premium. Right now, certainly is a pretty attractive time to be thinking about markets in general and listed investment companies in particular, given both the market falls and the expanded discounts that are available. We think for many people, the quarterly distributions will be an attractive feature with a target there of 5% per annum. And finally, we have managed, in fact, to deliver pretty reasonable returns in what has been a pretty rough market period over the last 3 or 4 years. Now, if you'd like to know more, certainly you can visit our website. There's a dedicated page for the LIC fund there where you can download or look at a whole range of more information, including more detail on the portfolio. If you're interested in investing, you can also follow the Invest Now link on our website to either invest online or download the appropriate forms. And we accept applications and withdrawals monthly for that fund on the last business day of each month. If you're not ready to invest yet, but you would like to keep in touch with us, we'd encourage you to subscribe on our website for our monthly e-news. And we send that out about the middle of each month. And it includes details of each of our funds' performance, portfolios, profiles of a couple of managers and LICs that we've invested with, and a few other things that we think are interesting in the world of investing. I hope that's been of use. If you are interested, please feel free to reach out in whatever way makes sense for you, via email, via phone or online. But in the meantime, thank you very much for watching and thank you for your time.